In this video, we'll use the present value method to calculate the liability and equity components and to explore the double entry treatment for convertible bond. So stay tuned. By definition, a convertible bond is a debt security that may give interest payments and the right and obligation to exchange the bond for a predetermined number of common stock or equity shares. Let's have a look at the following example. A company issued $30 million of 4% convertible bond at par on 1st of January. The bond is redeemable for cash or convertible into equity shares 3 years later at maturity. The market rate is 7%. We want to know what the balance sheet looks like after 1 year. First of all, we know that the company has to pay interest of 4% every year, so we shall calculate the present value of total interest in these 3 years. Next, since there is a possibility that investors would like to have cash when contract expires, therefore we shall also calculate the present value of redemption after 3 years. These two present values will be the liability element of the convertible bond. And the equity element will then be the proceeds on the bond issues, which is $30 million, minus the liability element of the convertible bond. Now let's take a look at the double entry treatment for these numbers. After issuing the convertible bond, the company will receive $30 million, so we debit bank by $30 million. Next we have the present values of interest and redemption as the liability element, and the balancing figure will be the equity element. They both will be on credit side. Since the market rate is 7%, therefore the company bears a finance charge of 7% times the liability element, and that would be an interest expense to be recognized in the profit and loss account, which increases the liability. Which is why we need to debit interest expense and credit liability. However, during the year the company has paid 4% interest to investors in cash, which has reduced the liability. Therefore we debit the liability and credit bank. Finally, the company's balance sheet after 1 year shall look like this. Under asset, in bank we have $30 million minus interest paid to investors. Under non-current liability, we have bond payable, which equals the finance charge and present value of interest and redemption minus interest paid to investors in the first year. And this gives us the net asset of $427,216. Finally, the equity will equal the equity element minus the finance charge to be recognized in the profit and loss account. Since equity includes the accumulated profit of the company, therefore the finance charge will be deducted in this part. So basically this is the accounting treatment for convertible bond. Thanks for watching. Remember to like, share, and subscribe for more. See you next time.